Hello and welcome to another episode of Nothing Ventured in the news for February 2026 with me, Arish Shah. Now, I am going to state right off the bat that I'm recording this a little bit early because I'm going to be traveling to East Africa in a day or so. So who knows? Some crazy stuff may well happen in the next week or so as we get to the run up to the end of Feb. One thing I would like for you to do is just keep your fingers crossed that I don't run into trouble because there is a baggage handler strike in Nairobi and I'm just a little bit worried I either won't get there or my bag is going to go missing. With that said, hopefully I haven't jinxed it. So let's get on with the show. So firstly, you can really feel the shift this month. I think one thing that has become really clear is that whilst AI has continued to hoover up capital across the board, the market has shifted somewhat and is now starting to say, that was a really nice demo, but I want to see the return, I want to see the moats, and I want to see the margins. And what that really means is that the mega rounds are still there, but that scrutiny has come back into play. And, you know, if you've been listening to this podcast for any length of time, you will know that someone like me that comes from that kind of finance CFO background, I've never really been comfortable with some of the lack of scrutiny we've seen over the last 5 to 10 years within venture, but it definitely feels like that's coming back. And we're seeing that happen in the public markets as well. They are now in prove it mode, right? So Microsoft is down something like 17% year to date, which is about $600 billion off of its peak market valuation. And Amazon is down just under 14% year to date, which is, again, just under $350 billion down. And this is really about investors questioning whether the spend that these companies have been going through in terms of AI is actually going to convert into realized profits and ultimately cash flow. Now, in the private markets, we're still seeing massive checks being written, but I think the shift has been that those checks are now being written when there is a credible why now. So what are some examples of that? So earlier this month, and this is a great success story for the UK, for Europe, is that 11 Labs raised a $500 million Series D at a $11 billion valuation with a reported $330 million plus ARR at the end of 2025 and a total funding of $781 million. Now, this is important. They have multiple channels and clients ranging from governments to traditional businesses and everything in between. So they are really showing that they've gone beyond, you know, this is a cool project, a really cool app. You know, you can dub your voice onto a film or dub an actor's voice into another language into something that is proving valuable in the real economy. We also saw Goodfire announce a $150 million Series B at a $1.25 billion valuation. And what they're selling is an opening up of the black box. So they are talking about interpretability, not just a bigger model. And what this means is that the money is still there, but the pitch has really fundamentally changed. We're no longer saying AI is going to change everything, albeit that there's a lot of posts on X and elsewhere which are still purporting that that is the case. And I would certainly say we are going to see mass change. But that change is coming from these companies by showing that there is a wedge, that they have distribution, that they have unit economics. So if funding is still flowing, the obvious next question is, are we actually getting liquidity out the other end? Now, again, if you've been listening to this podcast and if you've heard conversations we've had with various people, you will know that liquidity has been a really big problem in the world of venture over the last few years. And what that means is we're not getting returns back to LPs who are ultimately the people that fund venture funds, allowing them to unlock their next tranche of funding into the next funds. And this is clogging up the entire system. So maybe we're going through a bit of a great unlocking, but there's been a massive valuation reality check. So what we're seeing is that exits are up, but values are massively down. So S&P Global Market Intelligence has shown exit volume in 2025 rose to just under 3,150 companies. That's up 5.4% compared to 2024. But it announced exit value has fallen dramatically. It's 21% down versus 2024 at $412 billion. What this means is more deals, but smaller checks. Whilst Conversely, in the world of venture, what we're seeing is fewer deals with larger checks. So you are seeing bigger amounts of capital being deployed into fewer companies. The other side of this is that secondaries keep eating the world. The Financial Times reported something like $110 billion of aging fund stakes sold in 2025. And that's up 25% versus 2024, which sat at just under $90 billion. And that really suggests that the market, including continuation vehicles, which again, you've heard us talk about on the pod, has likely exceeded $200 billion, and some expecting that to rise as far as $300 billion in 2026. This is really important. LPs want their cash backs. If we're seeing that IPOs aren't happening, if we're seeing there is a window that is narrow or closed, or they're picky, and that M&A has become kind of a political activity, then secondaries become that release valve that allows that liquidity to flow back to investors, and then hopefully allows them to re-up and reinvest in new funds and keep the venture chain going. So where is deal flow actually landing right now? So I think if you follow the money, it's going to the real economy and it's going to automation. So we're seeing deal flow in categories like autonomy, in robotics, in logistics, in cyber. So Skyrise, which is in the sort of autonomy aviation space, raised $300 million at a $1.15 billion valuation, which was a Series C led by Autopilot Ventures, Fidelity, and Qatar Investment Authority. We're seeing humanoid robotics in the US with companies like Aptronic raising $520 million, which Reuters says was valued at about $5 billion as well, with a plan to expand to beyond 300 plus employees. In China, Limex Dynamics, which is in the humanoid robotic space, raised $200 million at Series B, with Techno reporting more than a dozen investors, including a multitude of strategic partners as well. We're also seeing deals in logistics and physical supply chain, with companies like Genlogs announcing a 60 million Series B, or equally in cyber with Radical raising $31 million at Series A to solve for SOC, right, in the bank security space. These are real world businesses that are being impacted by this technology, as opposed to nice to have AI wrappers, right? So the biggest checks are chasing places where software touches atoms. And I think this is going to be the massive story in 2026 and beyond. The moats that we expected to see in the past, or we certainly saw in the past with SaaS, being around either the software itself being a moat, or distribution, or markets and marketing spend being a moat, we're actually seeing hardware becoming a really resilient moat, which is why we're seeing money flowing into companies that support factories or freight or in defense, because this also touches on the other wider story, is that sovereignty is a massive, massive question and play for countries and companies across the globe today, as we're seeing kind of the globalization of the last 10, 20, 30 years starting to falter and potentially being unwound to a sort of more national story. So we are seeing this capital flowing into these businesses rather than just another AI wrapper with a productivity app. So let's bring it home. What is happening in the UK and Europe that isn't just we're also in the AI game, right? So the export story is, again, infrastructure software, right? So this is another example in a country like the UK, which has massive fintech and financial services industry, but also massive energy services. So Kraken was spun out of Octopus Energy, and this was first announced in December of 2024. And it's a really good example of B2B infra plus AI plus global distribution. The spin out was valued at something like $8.65 billion, with $1 billion of new equity, fresh equity, being brought in by existing as well as new investors. Octopus will continue to retain just under a 14% stake. But Kraken itself is contracted to serve something like 70 million accounts with $500 million plus worth of contracted annual revenue. The other really interesting thing here is that the British Business Bank has committed its largest ever direct investment of £25 million as part of the $1 billion demerger. It also states that Kraken processes something like 15 billion new data points a day. And again, going back to my point around moats, hardware, distribution, and proprietary data are the moats of the next year, 24 months and beyond. I think these are the things that are really going to show the companies that can accrue and retain value into the long term. This is the UK's strongest tech export pattern. It's not just apps, but it's actually almost operating systems for regulated, massively boring, but enormous industries. What about the plumbing, right? It's not sexy, but it does change what gets funded and how it gets funded. So the EU and the UK are showing signs of introducing legislation and plumbing that shapes how the venture capital and private equity industries operate. So in the EU, the Commission has opened a targeted consultation on EU venture and growth capital funds reform from early Jan with a deadline of mid-March. Now, explicitly, that's looking at barriers tied to EU VECA and AIFMD, as well as national frameworks. Now, the aim is reducing fragmentation and helping smaller managers scale cross-border. Now, if you think about that, what that means is you are flattening the landscape for venture capital funds to be able to operate across the whole of Europe. Therefore, hopefully, democratizing access, and I hate the word as I'm sure you do, but democratizing access to that capital so that funds in larger states can invest in smaller states and vice versa. In the UK, the FCA's PS 2514, which is about the definition of capital for investment firms, says that the rules don't change overall regulatory capital levels, but will aim to clarify own funds and reduce complexity. Now, that's coming into effect from the 1st of April 2026. So if you are fundraising a fund in Europe in 2026, that compliance surface area matters because less friction really does mean more experimentation, more ability to work across the board in areas that you wouldn't have necessarily been able to in the past. Whereas more friction does mean that more mega funds will just win by default. So what should we be looking out for the rest of February, maybe even into Q2? Well, firstly, do we think that mega rounds are going to continue to cluster into these few category kings, right? And we saw this at the back end of 2024, where close to 50% of all capital was going into a handful of businesses. Secondly, do we think that exits are going to continue to rise without those values and valuations recovering? And that's important, again, back to that liquidity point, because if valuations suffer and LPs are not seeing the returns that they would expect from venture, then the likelihood is that they are going to default to less risky but more stable assets with good returns. So if venture is not returning the outsized power law returns that one expects it to, then that capital is going to flow elsewhere. And I think we have to be really conscious of that potentially happening over the course of the next 12 to 24 months. Thirdly, what are the real economy AI lanes that are going to produce the next breakout story? Is it going to be robotics, logistics, energy, cyber, or is it going to be something else altogether? I think we are entering a period where building, in the truest sense of the word, now goes beyond software. We're seeing all the reports of Claude Code, of OpenClaw, of people being able to spin up agents and essentially write software in a massively compressed amount of time. That no longer is a moat, which means you can build stuff really quickly and test it out even faster than ever before. And therefore, when you're building something in the hardware domain, which takes execution, takes dollars, takes time, that then becomes a moat because it's not going to be as easy for the next guy to just replicate. In any case, what I think we're seeing is a really exciting new period within the story of venture. And I, for one, am definitely excited about what's going to come next. For the time being, thank you so much for listening to Nothing Venture News for February 2026. I'm Arish Shah. Remember, if nothing else, stay liquid.